Ever wondered how trading works? It's not as complicated as you might think. Welcome to the world of trading, a dynamic and potentially rewarding realm where assets like stocks, commodities, and currencies are bought and sold. Picture a bustling marketplace, but instead of fruits or fabrics, the commodities are abstract yet valuable assets. Trading is essentially the act of buying and selling these assets. You see, every asset has a price, and this price fluctuates based on numerous factors like supply, demand, and economic conditions. The aim of a trader is to buy an asset when its price is low and sell it when the price is high. It's the classic principle of buy low, sell high. But remember, timing is everything. Now you might be wondering, why trade? Well, trading can offer several potential benefits. For starters, it can be a way to make profits. You buy a stock for $50, for instance, and sell it for $60. Congratulations, you've just made a $10 profit. Trading can also be a means of building wealth over the long term. In fact, many of the world's wealthiest individuals have amassed their fortunes through savvy trading. But let's not forget, with great reward comes great risk. Trading is not a guaranteed pathway to riches. Prices can go down as well as up, and you could potentially lose your investment. It's a bit like a roller coaster ride, thrilling, but not without its share of dips and turns. It's also worth noting that trading requires a keen understanding of the market and a well-thought-out strategy. It's not just about making quick decisions, but about making informed ones. So, trading is not for the faint-hearted. It's a world filled with potential and peril, a world where fortunes can be made or lost in the blink of an eye. But for those who are willing to learn, to adapt, and to persevere, it can be a world of opportunity. So you've got a basic understanding of what trading is. Now, let's delve deeper into the process. Trading may seem daunting, but it's really a systematic process that you can easily learn. Let's break it down into simple, manageable steps. First up, you'll need to choose a trading platform. This could be an online broker or a mobile app. The key here is finding a platform that suits your needs, whether that's a user-friendly interface, a wide range of available assets, or top-notch customer service. Next, it's time to open a trading account. This usually involves filling out an application form with your personal information. It's a straightforward process, but make sure you have your identification documents handy. Once your account is up and running, the next step is to deposit funds. You can typically do this through a bank transfer or by using a credit or debit card. Remember, start with a sum you're comfortable risking, and never trade money you can't afford to lose. Now comes the exciting part: researching and selecting assets to trade. This could be anything from shares in a company to commodities like gold or oil to foreign currencies. Use the research tools available on your platform to help you make an informed decision. It's all about understanding the market trends and making predictions based on that data. Once you've selected an asset, it's time to place your trade. You'll need to decide whether you think the asset will increase or decrease in value. This is known as going long or short. Then specify the amount you want to trade and confirm your decision. Finally, there's the closing of the trade. This happens when you decide to sell your asset or buy it back in the case of short selling. The difference between the price at which you opened the trade and the price at which you closed it is your profit or loss. And there you have it, the trading process in a nutshell. But how do you decide what to trade? With so many assets out there, how do you choose what to trade? Now that's a question that's probably been nagging at your mind. And the answer, my friends, is research and analysis. Before you dive headfirst into the world of trading, you need to do your homework. And this comes in two forms: fundamental analysis and technical analysis. Let's start with fundamental analysis. This is all about studying economic indicators. It's about getting to know the health of the economy, the political climate, and any other factors that can influence the price of an asset. For example, if you're interested in trading a company's stocks, you'd want to know about the company's financial health, their latest earnings report, and any recent news that could affect their stock price. Now, onto technical analysis. This is where you become a bit of a detective, studying price charts and looking for patterns. you'll be analyzing historical data to predict future price movements. Are you noticing a trend? Is the price repeatedly hitting a certain high or low? These could be signs of what's to come. But here's the thing. Don't put all your eggs in one basket. This is where diversification comes in. By spreading your trades across different assets, you're not only minimizing risk, but also maximizing potential returns. Think of it as a buffet. You wouldn't just pile your plate with chips, would you? No, you'd want a bit of everything. Some salad, some meat, a little dessert. It's the same with trading. A little bit of stocks, some commodities, a dash of forex. That's a well-diversified portfolio. So whether you're eyeing up gold, oil, Apple stocks, or Japanese yen, remember to do your research, analyze the data, and diversify your trades. It's not about jumping on the bandwagon and trading what everyone else is trading. It's about finding the right fit for you based on your own analysis and risk tolerance. Remember, knowledge is power in trading. The more you know about an asset, the better your trading decisions will be. So go on, put on that detective hat and start analyzing. Trading isn't just about making profits, it's also about managing risks. Now let's dive deeper into that. You see, every single trade you make carries a risk of loss. It's a bit like stepping onto a tightrope. You could walk across successfully and reach the other side, or you could lose your balance and fall. It's thrilling, yes, but also fraught with peril. So how do you keep your balance? How do you ensure you don't fall too hard or too often? The answer is risk management. Imagine if that tightrope walker had a safety net beneath them. Even if they fell, they wouldn't hit the ground. They'd bounce back up, maybe with a bit of a bruise, but they'd still be in the game. In trading, your safety net is your risk management strategies. One such strategy is setting a stop loss. This is in order to sell an asset when it reaches a certain price. Think of it as a safety line. If the market moves against you and your asset starts to fall, your stop loss kicks in and sells it off, limiting your potential losses. It's like saying, I'm willing to risk a stumble, but I won't allow a full-blown fall. Another strategy is to only risk a small percentage of your trading capital on each trade. This ensures that even if a trade goes south, you're not wiping out your entire account. It's a bit like our tightrope walker only attempting tricks they're confident about, rather than going for a high-risk, high-reward stunt that could lead to a nasty fall. But remember, risk management doesn't guarantee profits. What it does is limit your losses. It's a way to make sure you live to trade another day, even when the market doesn't go your way. Risk management is key to long-term success in trading. It helps you stay in the game even when trades don't go your way. So we've covered a lot today, haven't we? We've taken a journey through the fascinating world of trading, unraveling its complexities and exploring its many opportunities. Let's take a moment to revisit the key points we've discussed. We began by delving into the world of trading, a dynamic and ever-evolving landscape that presents a myriad of possibilities. We discovered that trading isn't just about buying low and selling high, but about understanding the intricacies of the market and making informed decisions. We then moved on to the trading process. We learned that trading is a dance of sorts, a rhythm of buying and selling, of watching the market and making moves at the right time. It's a process that requires patience, diligence, and a keen eye for detail. Next, we discussed the importance of research and analysis in choosing what to trade. Established that you can't just throw a dart at a dartboard and hope for the best. It's about market trends, studying historical data, and keeping a finger on the pulse of current events. Then, we touched on the crucial role of risk management in trading. We highlighted that trading isn't a gamble, but a risk. It's about setting limits, knowing when to cut losses, and understanding that not every trade will be a winner. Throughout our journey, we've underscored the importance of knowledge and strategy. Trading isn't a get-rich-quick scheme or a game of chance. It's an endeavor that requires learning, skill, and a healthy respect for the unpredictability of the market. And that's trading in a nutshell. Remember, practice makes perfect. So get out there and start trading, but do it wisely and responsibly. If you found this journey insightful, don't forget to give us a thumbs up and subscribe to the 10 Billion Club for more exciting insights into the world of trading. We appreciate your support. Thanks for watching.